Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session on diagonal spreads, we'll take a look at how these spreads are constructed and how this approach might be one you'd like to add to your options toolbox. As always, we'll go through today's material in a quick 60-minute session, including our Q&A. Our presenter today is a senior specialist with OIC's Investor Services team, Mr. Bill Ryan. If you've ever called our Investor Services line at 1-888-OPTIONS, you may have spoken with Bill, who has been around financial markets for more than 25 years on, as he likes to say, the buy side, sell side, exchange side, and clearing side. Bill has been with OIC since 2000. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Bill will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Bill Ryan will bring you our topic today, diagonal equity call spreads, risk and reward. Bill?
Thank you, Nick. As you mentioned, Nick, I've been involved in the financial markets for over 25 years, and the product that holds my greatest attention and gives me greatest passion is the options product. Here's the OIC disclaimer with regards to the characteristics and risks of standardized options. Prior to buying and selling options, an investor must receive a copy of the characteristics and risks of standardized options. It's chock full of important information, and you should become familiar with this, as it will answer most, if not all, of your option-related questions. The examples that use actual securities are for illustrative purposes only and should not be considered investment advice. The good news is taxes, commissions, and fees are not factored into our examples. The bad news is that in real life, math is involved and taxes must be paid. The Options Industry Council is a not-for-profit organization funded by these 12 exchanges and OCC. These are the organizations that make the options world go round. The OIC was formed in 1992 to tell investors about the benefits and risks associated with options trading. When people ask me what my job entails, I tell them I have the best job in the world. I get to work with people who make the world safe for options trading. Here's a brief outline of our presentation. By the end of this webinar, we should be able to determine profit and loss calculations for diagonal bull call spreads, the steps that the investor would need to enter into, modify, and exit a diagonal spread, and also know that optionseducation.org offers the investor tools and resources that can help them plan their trade. An option spread is created with a purchase and sale of options of the same class on the same underlying security, but with different strike prices and or expiration dates. Spreads can be built with all calls, all puts, or both calls and puts. Spreads can be bullish, bearish, or neutral. And of course, the long and short side of a spread are called legs. Spreads are established or can be established at a net debit, a net credit, or even money. A debit spread is where the long leg costs more than the money received from the sale of the short leg. The trader that pays this debit is said to be long the spread. With a credit spread, more money is received from the sale of the short leg than is paid for the long leg or the buy side. The trader that receives the credit is said to be short the spread. Spreads are done in a margin account. Because of this, the account must have higher approval from the brokerage firm to be permitted to trade spreads. Also, the ability to trade spreads may include additional firm-specific requirements. You might, for example, not be able to trade spreads in an IRA account. Spreads are generally classified as vertical, horizontal, or diagonal. It's a popular way to classify spreads. With a vertical spread, a vertical spread, the long leg and short legs expire in the same month. They have the same expiration date. Any of the call options that it might expire in November 2014 could be used to construct a vertical spread. In this example of a long vertical call spread, for the November category, we would buy the November $85 call and sell to open the $90 call. This is also known as a bull call spread, and the long leg has a lower strike than the short leg. We are seeking price appreciation in it with a vertical call spread. The most this vertical spread will ever be worth is the difference in strike prices. So in our November example, this is a $5 bull call spread. When we buy the 85 call and sell the $90 call, we are paying a debit. We are paying more money for the $85 call than we are receiving for the sale of the 90 call. The most the spread will ever be worth is $5. The other example, the January 80-90 bull call spread, we're buying the more valuable leg. That's a $10 bull call spread. Again, the maximum value is the difference in strikes, $5 in our November example, $10 in our January example. The maximum risk, the most we can lose in this type of trade, is what we paid for the spread initially. Our initial debit paid is our maximum risk. A horizontal call spread, on the other hand, would as its name implies, involve only calls. They will have the same strike price, but different expiration dates. We have examples here of a January-November 95 horizontal call spread, or a January-November $90 call spread. These are often referred to as time spreads or calendar spreads. The chief objective in this type of a strategy is to collect time premium from the erosion of time, from time decay, the erosion of the time value of the contract. And of course, to be long the spread, your buy side must expire after your sell side. You have to own the further out contract. As we mentioned, an investor who is long a horizontal call spread seeks to earn the time value component of an option's price. Again, the same strike, different expiration dates. Our maximum risk is the net debit paid. Maximum profit is unknown, but the sweet spot is when the stock, or if the stock closes exactly at our short term or our short leg strike price at expiration. This strategy is generally considered a neutral strategy. However, strike price selection can give this spread type a directional bias. A quick note about the sweet spot and the expiration of our short-term or near-term leg. If the stock closes right at our short leg strike price, we are in what we have what we refer to as pin risk. The stock has been pinned to our short strike price. And even though the option is out of the money, there's a possibility that this contract could still be exercised. When traders have this type of position on and they're uncertain if the short leg is going to be exercised, the old trading desk maxim was, when in doubt, close them out. With our diagonal call spread, we buy the further out or longer term call option with a lower strike price and sell a nearer term, short term call option with a higher strike price. The example here is we are buying the January, we'll say January 2015 $80 call and selling the November 2014 $90 call option. It's a $10 diagonal call spread. And of course, since we are buying the more valuable leg, we're buying the deeper in the money or closer to the money call option. This is going to be done for a debit. Diagonal spreads are a combination of both the vertical and horizontal spread. I've often heard that this is referred to as a hybrid of the two. Again, we have different strike prices and different expiration dates. For the long diagonal call spread, our long leg, our buy side, is further out in time and has a lower strike price than our short leg. We seek price appreciation like a vertical spread. Of course, that's over the long term or during the time frame of our spread strategy. And we also seek the time value erosion much like a horizontal call spread. Again, the maximum risk is the cost of the spread, or the debit paid. And the sweet spot, our maximum gain at near-term expiration, is if the stock closes exactly at our short strike price. Using the tools and resources at optionseducation.org, we can find that company XYZ, the world famous company XYZ, is trading at $87 per share. It does not pay a dividend. We also can see that XYZ offers weekly, monthly, and leap options. Finally, we've also been able to note that the historic volatility of this stock is currently 30%. The investor is moderately bullish and has approximately a 4-month time frame. This is helpful for the strategist in selecting the expiration for their long leg or their buy side. Quick note about the lack of a dividend. In choosing a stock that does not pay a dividend, we are attempting to mitigate early assignment risk. When we sell a call option, and if eventually it does become in the money, it's quite common for a dividend-paying stock for call options to be exercised at the last possible moment. So what we're looking to do here is take that whole dividend play off the table. We're looking to reduce our assignment risk. The position simulator, which is one of the wonderful trading tools available on optionseducation.org, allows us to calculate theoretical option values and test strategies in the future and also in the past. I'd like to point out that we have in this screenshot of the simulator, we have a trade date of September 22nd. When we're planning our diagonal spread, we're going to look at the differential in the prices of the legs in determining the cost. Remember, when we establish a long diagonal call spread, a debit will be paid. It's generally recommended that investors trade in or out of the spread with a spread order, and the buy and sell of the legs would be done at the same time for a net debit or a credit. Execution of spread orders involves opening and closing transactions. When we're planning our spread, these are a few things we need to consider. Since a diagonal call spread involves the simultaneous purchase and sale of call options, both legs will be opening transactions. We'll be opening a position on our long leg, and we will be opening a position on our short leg. Questions that the spread trader should ask are, if I enter into a spread today, do I plan to roll the options? What if I'm assigned on my short leg? Must I repurchase my short leg? What if I want to exercise the long leg of my options contract? Should we let the short option expire worthless and simply close the long leg? And finally, what is my backup plan if the market goes against me? Remember, a short call option position can be assigned at any time. A short stock position will be created if stock is not owned by the spread trader. The assignment of a short call in a diagonal call spread could very well lead to a margin call and or other additional costs. Again, special approval from your brokerage firm might be required to enter into these types of spread trades. And you should always discuss the impact of assignment with your broker. This quote table allows us to plan our diagonal spread. We're looking to take advantage of the differential in time decay. Our long side, our buy side, our long call has a slower decay, and the short leg, the short call, will experience faster time decay. I selected a $10 diagonal call spread. I'm buying January 2015 $80 call, and I'm selling a November 2014 $90 call. As you can see, the January 2015 $80 call is worth approximately $10.19. The $90 call is worth approximately $3.10. Quick note, these prices are theoretical. We could say they're the midpoint between the bid and the ask. So our net debit, if we're paying $10.19 and taking in $3.10, our net debit is $7.09. If I were to enter this order on a spread, I would buy to open 1 January 2015 $80 call, sell to open 1 November 2014 $90 call for a net debit of $7.09. I don't care what the individual prices of the legs are. I just don't want to spend any more than $7.09. Our position simulator allows us to input the long and short legs of the spread into the simulator and view the profit loss diagram. I know the print's really difficult to read here, but we do in fact have the spread established for a debit of $7.09. As expiration approaches for our near-term expiry, our November contracts, I have a couple scenarios here we want to take a look at. If XYZ is trading lower, in this case $4 lower from the day we establish it at $83 per share, the investor can choose to close the spread out completely. Or they might consider buying back the near-term expiring November contract and rolling it into the next expiration. In this case, it would be the December 2014 contract. So we would roll the short leg. We would buy back the short leg and sell a new December contract and maintain the diagonal spread. On the other hand, if XYZ is unchanged in price at $87 a share, the near-term contract will expire worthless. The investor can close the spread out completely, or, again, choose to roll the expiring leg to the next nearest expiration. And again, finally, if the XYZ is trading $4 higher above the short leg strike price, the trader can choose to close the spread or buy back the in-the-money contract and roll to the next nearest expiration. It's important that when we roll from November to December, we're maintaining the integrity of the horizontal spread. Remember, our buy side has to, our long leg or our buy side must expire after the short leg to be considered a true diagonal. This is a graphic representation of world-famous XYZ closing at $87 a share at the near-term expiration. The observation I would have here is the fact that we don't have a definitive, sharply defined profit-loss scenario. The main reason being, of course, that we have a long leg that has a couple months left till expiry. I had a lot of fun putting this slide together. We can calculate our profits and losses, our profit and or loss on the spread with the stock at various prices at the November expiration. In the first example, we have XYZ closing at $79 a share. That's down $8 from the day we put the spread on. As you can tell, both our long leg has lost quite a bit of money, $6.82. Our short leg, the short call that we sold at $3.10, that's all profit. Of course, that call option is going to expire worthless. So the net effect on our position is we're down about $3.72. Considering the stock is down $8 a share, I guess it could be worse. Next example with XYZ at 83. Our long leg, again, we experience a loss on the long leg. We have a profit on the short leg, $3.10. Again, we're long the 80, short the 90. So that $90 call is out of the money. That $3.10 is all profit. The net effect, even though the stock is down $4 a share, on our diagonal call spread, we're down about we'll say $1.46, $1.50. This next example is with the stock unchanged at expiration, $87 a share. World famous XYZ hasn't moved since we put the trade on. What we have seen is the long leg, our buy side, has lost about $1.63. The short leg, or the sale of the $90 call, again, that's going to finish out of the money and worthless. So that $3.10 is all profit. And imagine, with the stock unchanged in price, in this example, we're looking at a profit with the stock unchanged on a bull call diagonal spread. Unchanged stock, we're looking at a possibility of a profit here. With the stock $4 higher at $91 a share, now we have our long leg has risen in value by $1.72. The short leg that we sold at $3.10, it's now in the money by $1. So that short leg profit is $2.10. The net effect on the position is a profit of $3.82. And then finally, the $91 a share, that's plus $4. And the last example is with the stock plus $8 at $95. Our long leg has risen in value by $5.37. Our short leg that we sold at $1.90, our short leg that we sold at $3.10 is now worth $5. That's a $1.90 loss. I apologize for the lack of red ink there. The net effect, our net position, that profit is correct. That's $3.47. Quick note, theoretical values aside, at expiration, an in-the-money option will move, or should move, dollar for dollar with the underlying security. We cannot say that that is what's going to happen for an in-the-money options contract that has a further out expiration. And thus, that's really the definition of this strategy. We're buying a further out, selling a nearer term. The example of the stock at 90, 91, and 95 shows us as XYZ rises further above the short strike, our profit declines. But worst case scenario, we'd still be looking at a profit of about $3. As the near-term expiration approaches, the investor should review the following: their forecast, their investment objectives, the prices, not only of of their options position, but of the stock itself. We also want to look at the position and consider potential modifications. And finally, we also want to think about the security in question. What about XYZ? Do they have any important news coming up in the near future? When do they announce their earnings, for example? Additional decisions and questions the investor has to ask themselves is, what happens if I'm assigned on my short leg? If I let the short leg expire, what would those consequences be? And of course, if the market moves against me, what can I do? Many diagonal spread traders consider extending the trade by rolling the soon to expire leg to a different expiry. The new leg must expire before the long leg and have a higher strike to be considered a long diagonal call spread. That's a lot there. We have to, so again, back to our previous example, we are buying back to November, selling December. We are long January 2015. So that meets our criteria for to continue the diagonal call spread. And of course, the position simulator can estimate theoretical call prices for us. This is quite similar to the previous slide. The only observation here is that while the position simulator can calculate theoretical values, real-time prices will be your friend when deciding if and when to close the spread or roll the soon-to-expire leg. And again, with the spread, with rolling the leg, if I roll the spread, the new short leg creates an open short position. We are short a call option again. So the questions remain: do I plan to repurchase that short leg? What if I'm assigned? Should I carry the position until expiration and hope it expires worthless? And what is my backup plan if the market goes against me? Diagonal spreads illustrate the versatility and utility of options. The diagonal call spread strategy is not a passive strategy. You have to be involved and you have to work the spread. You also, if your plan is to roll the spread, you may have to be prepared, or you might have to be ready to roll on short notice. So you need to be prepared. Finally, OIC can help you plan your trade and trade your plan. And in conclusion, you need to know your stock, know your broker, and know your options. Nick, I think we have plenty of time to take some questions.
We do indeed, Bill, and I want to remind everyone that it's been a very efficient afternoon for diagonals, but efficiency is also a very solid option strategy when you're approaching this. And ladies and gentlemen, also as a reminder, if we're not able to make it to your question today, you can always give Bill or one of his colleagues a call at 1-888-OPTIONS, or you can visit optionseducation.org to connect with our other options professional. With that said, Bill, we've got a number of questions today, and a couple of them focused on some similar topics, so hopefully we'll be able to take them as a group. One person asked that you mentioned the phrase, when in doubt, close them out, when you were referring to pin risk. Are you talking about closing out one side or both sides of the spread? Which are we closing here?
Well, pin risk refers to the assignment risk of, or the uncertainty of assignment for the short leg. So when we talk, when you know the old trading maxim, when in doubt, close them out, refers to the short assignable leg in this trade. Because again, we're talking about a November expiration for our near-term contract. We need to make sure that we're not going to be surprised that, hey, you know, Bill, the stock closed at $90 a share. Actually, Bill, the stock closed at $89.99. How in the world, or why in the world, would somebody exercise that $90 call? That's the type of questions we get. And, you know, we don't have to understand the reasoning behind the call option exercise. But to avoid assignment, you close that short leg out. You know, if it's close to the money and you're not sure if you will be assigned, I think when in doubt, close them out is the way to go.
Bill, continuing on that idea of pin risk, is pin risk only a concern on expiration day?
No, it's not really a concern on expiration, just on expiration day. For those securities, for those stocks that pay a dividend, and in an options contract that is slightly in the money or in the money by just a penny or two, can of course be exercised. One of the reasons I selected this stock in question, it's a biopharmaceutical company, by the way, but the reason I selected that company was they did not pay a dividend, and again, I'm trying to, of course, we can never eliminate all risk. If we have no risk in our investment, well, we shouldn't expect any rewards. In this case, though, we're trying to mitigate or minimize the assignment risk, and again, this might, this not to be construed as investment advice, but if I'm uncertain, if I don't want to be assigned, and I'm uncertain that I may or may not be, if I'm not sure that I'm going to be assigned, we can eliminate all those questions by closing the contract out.
Great, thanks, Bill. So a couple questions that we had were about assignment. Is it easy to determine when the short side of the position might be assigned?
Oh, that's a great question. As we know, an options contract is an options premium is comprised of two components. Its intrinsic value, or in the money amount, and its time value, which is everything other than the intrinsic, which is the premium that is represented by everything other than the intrinsic or in the money value. Only in the money call options have intrinsic value. Out of the money call options are all time value. So to answer the question, we never really know. We can't predict what an option holder will do. But if an options contract is in the money, so it has intrinsic value, let's say, for example, the stock is trading at 91, and the $90 call is trading at $1.10. Well, it's got 10 cents worth of intrinsic value. I'm sorry, it has $1 of intrinsic value, 10 cents worth of time value. This is 10 cents is not a lot of money in the spread business. Oh, I take that back. 10 cents can be the difference between a profit and a loss. But if you do not want to be assigned, when there is little or no time value in an options contract, that's when early assignment risk is at its greatest. As we know, most exercises occur late in the life of the contract when there is little or no time value left. In our example, if it's a $90 call and the stock is trading at 91, and we see that call option bid 95 cents and offered $1.05, that's a for me, I would think that's a prime candidate for early exercise. It's being quoted a nickel below its intrinsic value. So if you want to be assured of getting the intrinsic value out of an options contract, you can exercise it.
Bill, what are some of the advantages of a diagonal spread versus a calendar spread?
Well, I think the main advantage is, they're actually two different strategies for a reason. The calendar spread is looking to capture time premium. The horizontal, on the other hand, that was the correct choice. Is horizontal versus diagonal, right, Nick?
It was diagonal versus calendar spreads in this question.
Okay. Calendar spread and horizontal are the same. So the calendar spread looks to capture time premium. The diagonal seeks to capture time premium, but it also is looking, it's also got an attitude. It's got a bias. We were looking at diagonal call spreads. You can have diagonal put spreads as well, but a diagonal call spread, we're also looking for price appreciation. So this, we know a stock can go up, go down, or move sideways. The calendar spread is perfect for a sideways moving stock. The horizontal or calendar spread is perfect for a sideways moving stock, but we can't predict the future. On the other hand, a diagonal spread can profit from a sideways move, as we illustrated in our examples. And of course, if the underlying security rises in value, we will benefit from that as well. So of the two of the three things that can occur with the underlier, go up, go down, move sideways. If it goes up or moves sideways, this diagonal spread, this diagonal bull call spread, could very well be profitable.
Thanks, Bill. Another question that we had was about volatility. How would this investor consider the implied volatility of both legs when opening up a diagonal spread?
That's a wonderful question. Implied volatility is the option market's estimate of volatility for this specific option, this specific strike price. The strategist might consider comparing the implied volatility of the option contract to the historic volatility of the stock. If there is a very large discrepancy, if there's a big difference between the implied vol and the historic vol, I think more research is required. If the implied volatility is substantially higher, the market knows something's happening. It could be something as straightforward as, hey, they announce earnings at the end of the week. Or they've got a product in the pipeline and they're awaiting government approval. I don't know if those answers would assist the strategist, but if there is a big difference, we have to ask why. I don't know if we'll ever know the answer, but we should be curious as to why there's a large discrepancy.
Great, thanks, Bill. Another question we had was about selecting a range between the long and the short months. Basically, how do we make that selection? Do we use a standard deviation model? Do we use a probabilistic model? What's a good way to select that range between the long and the short?
Well, when I first started looking into this strategy, some options people that I know mentioned that this strategy works best generally speaking, it works best with when the underlying moves between 5 and 10%. in this day and age of high-flying stocks that could move, 40, 50, 60, 70% in a year, and 10% is considered sluggish. A 10% rise or fall is considered sluggish. Personally, the stock I selected was going to have an earnings announcement in between the expiration of my November contract and my January expiry. I wanted to capture that, I wanted to capture that what I would perceive to be increased in volume in the stock, and it's not uncommon to see volatility have a cyclical nature. As earnings comes out, the volatility starts to climb, or as earnings day approaches, I should say, the announcement day approaches, volatility tends to climb. So we can take advantage of that. We can sell into that strength. My forecast was I had a 3 to 4 month forecast on my stock, and that helped me choose my long leg. I chose January 14th. I suppose a case could be made that you could have selected December, but I wanted to give myself a little bit of safety in that respect. I want to give myself a little bit of wiggle room. Rather than just December, if I select January, I can roll my trade if necessary or close it out completely.
Bill, we had another question about order types. So what type of orders should this investor use to enter into, modify, or close the spread?
Well, I believe we mentioned this, but just to make sure, I'm of the opinion we would want to enter into the diagonal spread with a spread ticket. So again, our buy side would be buy to open the January $80 call, January 15 $80 call, sell to open the November $90 call, November 2014 $90 call, for a net debit of, our calculation was 709. So that order would be, and again, it's an opening transaction on both legs. So that trade, that trade would be entered into as a limit on a limit order spread ticket. Once the spread's been established, should we decide to close the spread out, again, I'm of the opinion we just close the whole thing out. You buy back the November contract, sell the January contract. You're selling the more valuable leg. You should take in more money than you pay out. It's going to be done for a credit. You would be buying to close, selling to close for a net credit. The interesting question, or the interesting one, is the modifying the position where we consider rolling the leg, rolling that near soon to expire leg, the November contract. In that situation, again, I would recommend a spread ticket. We are buying to close the November $90 call. We are selling to open. It could be the same strike of 90. If the stock's moved in our favor, we might be able to roll to a 95. But we would ideally be taking in a credit. We will be receiving more money than we pay out. And finally, for the pin risk trade, where the strategist does not want to be assigned on the short leg, but they do not want to close out their long leg at this time, or close it out as a spread order, we would simply buy to close the soon to expire November contract. But then we don't have a spread anymore. We're simply long a call.
Bill, we talked a little bit about the short leg and assignment on that short leg. But how far out should that short call be?
You know, that's a fair enough question. When I was looking at this security in question and realized what months would be available, the October contracts didn't really particularly excite me as a candidate. Less than, approximately 30 days till expiration. The premiums just, they weren't that attractive. On the other hand, when we buy the $80 call, sell the $90 call, I'm getting $3.10 time premium when I sell that call option. The total cost of that spread is $7.09. Okay. One of the reasons I selected the $80 call and for the buy side and the $90 call for the sell side was, I wanted a $10 spread. You know why? I don't know, but I wanted my buy side to be in the money. I wanted my sell side to be out of the money. I paid $7.09 for my spread. If I were to be assigned on the short leg, that means I'm selling the stock at $90 a share. And if my plan was to exercise my long leg to meet my delivery requirements for assignment, that means I'm buying the stock at 80. Okay, my $80 call. I'm buying it at 80, selling it at 90. I've made $10 on that transaction. Of course, there ain't no free lunch. I paid $7.09 for the spread, and now I'm selling it at $10. My total profit is somewhere in the neighborhood of $2.90, 91 cents on my initial $7.09 spread. I don't have my calculator handy, but I think that's somewhere in the neighborhood of 40%. Pretty attractive.
Bill, we were talking about the ranges of strike selection. Can you talk about a little bit of how delta plays into the selection of either the short or the long leg?
Oh, certainly. We know that delta seeks to measure the pricing relationship between an options contract and the underlying security. Call options have positive delta. Put options have negative delta. We're talking strictly about call options here. Again, delta is expressed as a percentage. If an option is said to have a delta of 70 or 70%, and we're talking about a call option, if the stock were to rise $1, the call option in question is expected to gain 70 cents. When I used the simulator in checking prices and considering establishing the diagonal spread, if I'm not mistaken, I don't want to go back to the chart there, back to that slide, but I believe my long leg had a delta of over 70. So it's expected to move 70 cents of the dollar. No guarantee, but still a pretty high number in my opinion. Our short leg, I believe the delta was in the 40-ish range. It might be a little high. I suppose I could go back and look, but the delta could so the position itself, I'm long a call and short a call. So I've got the long delta. My long leg has a delta of 70 or so. My short leg has a delta of, I believe it is 38%. But the net position is, as the stock rises in value, I'm going to, if and when the stock rises in value, I am going to probably be making 40 cents to the dollar on that with the short
Great,
call
well,
gives us negative. Yeah, I'm sorry.
No,
Go ahead, Nick.
yeah.
No.
Do you want to keep answering this one?
Well, no, I don't. I'll be honest with you. I don't know if I've answered the question sufficiently to start with, but I believe the attendee's question was, can we talk about delta and its effect on a spread? Well, our buy side, we are long delta on the calls. Sell side, we're short delta. When you combine them, something that the position simulator can do for us, we can put this spread in the simulator, and we can have the simulator calculate our net delta. It's a really valuable tool for spread strategists and investors, and I really encourage you to take a look at that when you get the chance. And of course, the callers can give us a call at 888-OPTIONS. That's 678-4667, and we can walk you through the simulator and show you how to put this thing through its paces. It's a valuable tool that I believe will help you become a better trader.
Bill, I'm glad you mentioned the position simulator, because one of the questions we got was about buying an options analysis program and what recommendations do we here at the OIC have. And I think you answered it right there. I think the position simulator on our website is exactly the tool that we would recommend, and I know you walk investors through that tool every day. So
yeah, this is the simulator, of course, has some limitations. It doesn't take real-time data. It's only as good as the information that the user inputs to the simulator. But if we have accurate quality information going in, we should expect accurate information coming out. We would never, we're really in no position to recommend one analytical service or software program or quote vendor versus another. We're just not in that position. Traders have different needs, different requirements, and a lot of these data vendors will customize their product to the very specific needs of the client. This is sort of a one-size-fits-all, off-the-rack position simulator, but it's pretty cool. I mean, it works well, and there's some interesting features in this simulator that I don't think most users are wholly familiar with. For example, when I set up the simulator and I input the information about the security in question, world famous XYZ, I put a trade date in of September 22nd, which conveniently enough is 1 week after the 2017 leaps would have been listed or been available for cycle 1 stocks like XYZ. And when I selected my strike prices, when I was inputting the spread information into the simulator, one of the expiration choices I was given was a January 2017 expiration. It was really, I was pleasantly surprised. I've been using this simulator for years, and I never even noticed it. Again, I never really thought to forward my forecast a week into the future, or 2 weeks into the future, as the case may be. But it was a pleasant surprise, and it really is a handy tool.
Bill, thanks for the walkthrough on that. I know it's something that you talk to all of our investors about multiple times a day, and I hope that they found it as good of a tool as you say it is. So, ladies and gentlemen, we're coming up right at the end of our session today. So, Bill, do you have any closing thoughts for our attendees this afternoon?
Well, if you do have any questions, feel free to give us a call at 888-OPTIONS. That's options, OPTIONS, 678-4667. Of course, you can always send us an email at options@theocc.com. And we certainly welcome your calls in the future.
Ladies and gentlemen, I know we got a lot of great questions there right at the end, but as Bill said, feel free to give him and his colleagues a call anytime at that phone number. The position simulator that he mentioned is available under the Tools and Resources drop-down of the OIC website, so feel free to use that, play around with it on your own time, and hopefully you can get some great information out of it. We'll be holding our next webinar at the end of September, so feel free to check optionseducation.org or keep an eye on your email for that sign-up link. As a reminder, these webinars are all archived through On24. You can use the same sign-up and joining link that you used today to attend, and you'll be able to see the on-demand version starting later this evening or tomorrow morning. Ladies and gentlemen, thank you so much for attending, and we hope to see you again at our next webinar.